$47 billion. That was the number on the wall in January 2019, the valuation SoftBank placed on a company that rented desks, not software, not patents, not a platform with zero marginal cost. Desks. And then, 8 months later, the company filed to go public, and anyone who read the prospectus could see it plainly. The losses were accelerating, the governance was extraordinary, and the man at the center had already extracted hundreds of millions for himself. The IPO was pulled. The valuation collapsed. And in 6 weeks, $47 billion became a rescue package worth less than 8. How does Adam Neumann co-founded WeWork in New York City in 2010 alongside Miguel McKelvey. The original concept was straightforward: lease large commercial office spaces on long-term contracts, subdivide them, and sublease that space to individuals and small businesses on flexible, short-term terms. It was, at its core, a real estate arbitrage play. The margin lived in the spread between what WeWork paid landlords and what members paid WeWork. But Neumann did not pitch it that way. From the earliest investor conversations, he framed WeWork as a technology company, a platform, a community, a movement. The physical offices were, in his telling, the software was the network effect. Thousands of entrepreneurs, freelancers, and startups sharing space, sharing ideas, generating data. He spoke of elevating the world's consciousness. He spoke of WeWork becoming the world's first trillion-dollar company. These were not footnotes. They were the pitch. And investors listened. In 2012, the company raised its first significant institutional round. By 2014, it had crossed a valuation of $1.5 billion. By 2015, $5 billion. The offices were genuinely striking. Exposed brick, craft beer on tap, communal table. Revenue was growing fast. On the surface, the momentum was real. Then came SoftBank. Masayoshi Son's vision fund began investing in WeWork in 2017. Over the following 2 years, SoftBank and its affiliates would pour approximately $10.5 billion into the company, according to SoftBank's own disclosures. Son reportedly met Neumann, toured a WeWork location, and committed to a significant investment within minutes. The Vision Fund's model was to identify category-defining companies and flood them with capital before competitors could react, a strategy that had produced extraordinary returns with Alibaba and that Son believed could be replicated across dozens of sectors simultaneously. For WeWork, the capital arrived in waves, and with each wave the valuation ratcheted upward, not because the underlying unit economics had improved, but because the most recent investor had agreed to a higher price. By January 2019, after SoftBank's final major investment round, the implied valuation stood at $47 billion. WeWork was, by that measure, one of the most valuable private companies. Neumann's personal position was extraordinary. He had taken hundreds of millions of dollars in personal loans secured against his WeWork shares. He had, according to the company's own S1 filing, purchased buildings and then leased them back to WeWork. Transactions in which he sat on both sides of the negotiation. He had trademarked the word "we" personally and then sold that trademark to WeWork for approximately $5.9 million, a transaction later reversed after public scrutiny. He traveled on a private jet. He spoke of WeWork outlasting any government on earth. The story, as told from the inside, was one of inevitable world historical success. In August 2019, WeWork filed its S1 registration statement with the Securities and Exchange Commission. It was a public document. Anyone could read it. And what it contained was, for many analysts and journalists who had covered the company from the outside, a confirmation of suspicions they had long held but struggled to prove. The losses were staggering. For the full year 2018, WeWork reported a net loss of $1.9 billion on revenue of $1.8 billion. The company was, in the simplest terms, spending more than $2 for every dollar it brought in. In the first half of 2019 alone, it lost $900 million. It was worsening. But the losses alone were not the most alarming element. It was the structure of the business underneath them. WeWork had signed long-term lease obligations totaling approximately $47 billion, a figure that appeared in the S1 itself. Against those obligations, the company's committed future revenue from members was a fraction of that number. The business model required WeWork to keep filling desks indefinitely at prices that would eventually cover not just the rent, but the enormous overhead of build-out, staffing, and corporate expansion. If occupancy fell, in a recession, in a sector downturn, in any sustained period of economic disruption, the lease obligations remained. The members could leave on short notice. The landlords could not be dismissed. Here is what no one on the outside had fully seen coming. The governance disclosures were, in some respects, even more striking than the financials. The S1 revealed that Neumann held supervoting shares, giving him effective control over the company, regardless of what other shareholders wanted. It revealed the related party real estate transactions, the buildings he owned that WeWork was renting. It revealed the trademark sale. It revealed that his wife, Rebecca Neumann, held influence over the selection of his successor should he leave the company. The document described WeWork's business not as technology, but, in several key passages, as real estate, a categorization that carried profound implications for how the company should be valued. The market reacted immediately. Analysts who had accepted the $47 billion figure as a working assumption began revising it downward, sharply. Some placed fair value at $15 billion. Others said 10. A small number said the company, with its lease structure and its losses. Media coverage intensified. The Wall Street Journal, which had been reporting critically on WeWork's governance for months, published a series of detailed pieces examining Neumann's compensation arrangements and the company's financial disclosures. Questions about whether WeWork had ever been a technology company or had simply been marketed as one to attract a valuation multiple that real estate companies do not receive became the central axis of public debate. The IPO roadshow, which had been intended to generate institutional demand for the offering, was instead generating skepticism. Potential investors were asking questions that the company's bankers could not answer to their satisfaction. The target valuation for the IPO had already been cut from the $47 billion private market figure to somewhere between $10 and $12 billion. Then it was cut again. The board met. Discussions about the future of the offering and the future of Adam Neumann's role were underway. On September 24, 2019, Adam Neumann resigned as Chief Executive Officer of WeWork. The announcement came after days of reported negotiations between Neumann, the board, and WeWork's largest backer, SoftBank. According to reporting by the Wall Street Journal and subsequent court filings related to shareholder litigation, the board had lost confidence in Neumann's ability to lead the company through a public offering under the conditions the S1 had created. The resignation package was extraordinary in its own right. Under a deal negotiated at the time of his departure, Neumann was set to receive consulting fees, loan forgiveness, and the right to sell shares. Arrangements that were later reported to be worth nearly $1.7 billion. SoftBank subsequently moved to reduce those payments, and litigation between Neumann and SoftBank followed, ultimately reaching a settlement whose terms were not fully disclosed. The IPO was formally postponed on September 30, 2019. 6 days after Neumann's resignation. And now the crisis became existential. Without the IPO proceeds, the company had been counting on the public markets to provide the capital it needed to fund continued expansion. That capital was gone. WeWork's credit rating was cut. Reports emerged that the company could run out of operating cash within weeks. SoftBank intervened. In October 2019, SoftBank announced a rescue financing package that gave it effective control of WeWork. The deal valued the company at approximately $8 billion, a reduction of 83% from the January 2019 peak of $47 billion. SoftBank's total exposure to WeWork across its various investments in the rescue package was reported at over $13 billion. But here is the detail that makes the timeline almost impossible to process. The distance between WeWork's peak valuation and its rescue valuation was not years. It was not even 1 year. From January 2019 to October 2019, the company's implied value fell by $39 billion in 9 months. The S-1 filing, a document that companies routinely file as a formality on the road to a successful public offering, had functioned instead as the mechanism of exposure. The human cost was immediate and concrete. WeWork announced layoffs of approximately 2,400 employees in November 2019, representing roughly 19. These were people who had joined a company that, by every public signal available to them, was on a trajectory toward an IPO and the financial security that implied. Their stock options in many cases were worth nothing. Their jobs were gone. The company also began unwinding a series of acquisitions Neumann had made during the expansion years, businesses that had been purchased at prices that now seemed difficult to justify. Real estate commitments in markets where WeWork had overexpanded were renegotiated or abandoned. The physical footprint that had been the company's most visible symbol of momentum became, almost overnight, its most visible. But the version of WeWork that had been sold to investors, to employees, and to the public, the $47 billion technology platform that was going to change the nature of work itself, was gone. WeWork filed for Chapter 11 bankruptcy protection in the United States in November 2023. By that point, the company had gone public through a SPAC merger in October 2021 at a valuation of approximately $9 billion, a fraction of its 2019 peak, but still a figure that struck many observers as optimistic given the company's financial condition. The public market confirmed their skepticism. WeWork stock declined steadily after listing, and by the time the bankruptcy filing came, the company's market capitalization had fallen to a small fraction of even that reduced number. The bankruptcy filing listed liabilities of approximately $18.6 billion and assets of approximately $15 billion, according to court documents filed in the District of New Jersey. Adam Neumann did not face criminal charges in connection with WeWork. The SEC did not bring an enforcement action against him personally for the events surrounding the IPO filing based on the public record available. He did, however, face civil litigation from shareholders and from SoftBank, and the settlement of those disputes consumed years of legal proceedings. Neumann moved on to other ventures. In 2022, he announced a new real estate startup called Flow, which raised approximately $350 million from the venture capital firm Andreessen Horowitz at a valuation reported to be over $1 billion before the company had launched a product. SoftBank's losses on WeWork were substantial and documented. The Vision Fund reported write-downs related to WeWork that contributed to multi-billion-dollar quarterly losses. Masayoshi Son acknowledged publicly on multiple occasions that the WeWork investment had been a serious mistake. SoftBank's overall Vision Fund reported a net loss of approximately $27 billion for the fiscal year ending March 2023, with WeWork among the most significant contributors to that figure, according to SoftBank's own financial disclosures. The employees who lost their jobs in the 2019 layoffs received, in most cases, severance packages that were negotiated under pressure during a financial crisis. Many of their stock options expired worthless. The landlords who had signed long-term leases with WeWork found themselves in protracted renegotiations, with some recovering a portion of what they were owed through the bankruptcy process and others absorbing significant losses. The WeWork story entered the culture in ways that few corporate collapses do. A documentary, a scripted television series, and extensive long-form journalism examined the mechanics of how a company with straightforwardly negative unit economics had reached a valuation that placed it alongside genuinely transformative technology businesses. The question those accounts kept returning to was not unique to WeWork. It was about the conditions that allow a story to substitute for a business model, and about the role that large concentrated pools of capital play in sustaining that substitution long past the point where the math has stopped working. The lesson the WeWork case leaves in the public record is a simple one. A valuation is not a fact. It is an agreement between parties about what a thing might be worth, and that agreement can be withdrawn the moment anyone is required to show their work.